Hello and welcome to Econoday Unplugged on Tuesday, the 5th of November 2019. Mark Pender is on the US East Coast, Brian Jackson joins us from Sydney, and I'm Jeremy Hawkins here in London. As usual then, since we have Brian with us this week, let's kick off in the Southern Hemisphere. Brian, Bank of Japan, no change from the BOJ last week, but some tweaking of the forward guidance, perhaps suggesting an increased willingness to be more accommodative further out?
Yeah, they've been flagging this for a few months now. They've introduced a new sort of phrase into their lexicon, all about momentum. So they're all about just how much momentum there is towards meeting their inflation target eventually. I don't really think that there's a great amount of momentum at the moment. We've seen in the inflation numbers over the last few months both the headline and the underlying measures of inflation just sort of bumping around and not really making a lot of progress. So that's definitely putting, I think, some pressure on the Bank of Japan, and they've responded in this way by, just indicating that they'll keep policy at the very accommodative levels, for a longer period. Now the phrase is we'll keep it at rates at these low levels or even lower, as long as we have to consider the possibility that we're going to lose momentum towards meeting the inflation target.
Is it not the case, if I saw rightly, they actually reduced their inflation forecast last week? Is that right?
They did, yes. They tweaked.
So how do they how do we justify not doing anything?
Well, I don't know if something's lost in translation. I think they say that there's still some momentum towards the inflation target, in that inflation isn't sort of really heading in a negative way, heading downwards. They're just reducing the forecast for how far that's going to go up. So I think you could still say that there is some progress being made towards that target, but it's just not as fast as what they had previously thought. And of course, this has been a long-standing feature of Bank of Japan inflation forecasts. They've often had to tweak them lower and sort of push back the expected date for when they're going to meet the target.
Yeah, same sort of thing with a number of central banks these days, isn't it? One of which, I suppose, we include the RBA. So no change, was it, overnight? But that's no surprise, I guess, after the three cuts we had earlier on this year. But what exactly are they trying to meet this inflation target, or is it the case they're more concentrating upon the labour market and unemployment now?
I think they are a little bit concerned that the inflation now has been below their target for, I think, 4 or 5 quarters, quite some time now. So I think that is causing them some consternation, but they're also mindful that unemployment rate is above 5% and has been for a while, so they think that there's scope to get that down. But there's a real policy debate happening in Australia right now about just how much more the RBA can do. We're at 0.75% for the main policy rate, which it's never been there before. And I think there is some concern out there that you don't want to go too close to zero, into sort of uncharted territory, and what else can be done. And so what we're seeing is a lot of pressure now being put on the government to do more on the fiscal side of things. You've had the RBA Governor Lowe quite explicitly say that he thinks there should be some more spending on infrastructure and other fiscal tools, and that's becoming quite a part of the debate now. The trouble is that the Australian government has made a pretty firm commitment that it wants to get its budget back into surplus ahead of the next election. So we're coming up to their mid-year fiscal review in December, and that's where the focus is really going to be.
Interesting. Okay, let's go across the water then. Hong Kong. So I think we're writing saying now that the Hong Kong economy is technically in recession. And from what I saw, was that the October PMIs didn't look too clever either. So, how much of this is just due, do you think, to political unrest? And indeed, to that extent, is there any sign of this unrest coming to an end?
And that's obviously the big factor that's led to this further downturn. We already had the Hong Kong economy in pretty subdued territory going into this, just because of the US-China trade disputes, just weak demand from mainland China. So at the start of the year, we had the PMI sort of below 50 consistently anyway. But this latest downturn, it's all about the impact of the civil unrest. It just seems like Hong Kong's closed for business right now. You've got the PMI headline index below 40, in the 30s. I don't think we've seen that really anywhere since the global financial crisis of 2008, 2009. So it's a pretty dire situation, and the government has been forced to try and provide some support to the economy over the last few months. But until they do something to resolve the civil unrest, I don't think you're going to see a big improvement in conditions there.
Brian, this is Mark. I have a question about the mainland China, weak demand from mainland China. Is that politically motivated?
So you saying the Beijing? Well, I think what we are seeing is that
are they putting pressure on them economically?
No, I don't think it's so much Beijing is trying to send a signal to the Hong Kong government, because the Hong Kong government is trying to do what Beijing wants it to do. But I think there could be a situation where some Hong Kong consumers are boycotting mainland Chinese firms out of their sense of protesting against what Beijing is doing. So there could be a bit of an impact of that. You've definitely had some pro-Beijing business people in Hong Kong see that their businesses have been targeted for protests and boycotts by the protesters, because they're trying to send a message to Beijing.
But not the other way around.
I mean, there could be to some extent, but again, I think what we want to see from what Beijing wants to see is the Hong Kong government keep its authority and its credibility. So I don't think they're happy about this downturn in activity.
Is there any contagion risk with Hong Kong
through to mainland China?
Financial markets, a continued deepening recession, would that have any possible issues in the financial markets, loan defaults, that stuff?
I mean, that at the margin, that can happen. But I think what we are seeing is that, generally speaking, financial markets have been relatively insulated from what's going on here. You still see the Hang Seng Index sort of tracking broader regional moves, and the Shanghai Composite I don't think has been too impacted by it.
Okay, sticking quickly with China, I noticed we saw the renminbi yuan rally briefly through. Was it 7 to the dollar today? Is that just on the back of what appears to be growing hopes that we'll get some kind of trade settlement, at least around one of a trade settlement between the States and China? Or is there some better news coming out of the economy which perhaps might justify it?
I think it's both is happening. We have seen over the last couple of weeks a growing confidence that something is going to be done on the US-China trade situation. We have Asia-Pacific economic leaders meeting soon, and perhaps that will be the forum where we'll have some major announcements. We are also seeing just the People's Bank of China tweaking some of its sort of interbank rates to try and improve liquidity conditions. Not a great amount. I think they're wary of being too aggressive. Given what has happened in previous episodes when they've tried to stimulate the economy, and we just had this huge explosion in debt, particularly by sort of state-run enterprises and local governments. So I don't think they want to do too much, but they have tweaked around the edges. And you have seen, if you look closely at some of the PMI numbers over the last couple of months, a little bit of improvement. It's still fairly subdued, but at least not moving in the wrong direction now.
Okay. Excellent. Thank you very much for that lot. Okay, well, back to central banks who are still busy cutting interest rates, or at least have been. Mr. Pender,
yes.
Last week then, a third interest rate cut from your side this year. But now we got Mr. Powell saying Fed policy was in a good place. So does that mean we're on hold now?
Basically, that was the unsaid conclusion of the meeting, that enough is enough for right now. The consumer is so strong right now, and the labor market is still creating enough jobs that they're going to step back, or they're going to let the indicators unfold and go from there. So it was, you have to talk. You give in one hand and you take back in the other, and so I think that's a little bit of that.
Strong non-manufacturing ISM from your side, I noticed earlier on today. Are we talking a rebound in services now?
It was a good report, but we also had another services report from market economics that preceded this morning's ISM report, and it wasn't as upbeat. And if you actually looked at the numbers within the ISM report, you'll see it's still pretty soft. There was they drew down backlogs to keep output up. Also, the general trend of this report, which had been very strong, one of the strongest sample surveys over the last several years out of the U.S., and it has kind of deflated, fizzled. So even a 54.7 for this, it's among the lowest readings in several years. So I wouldn't go too overboard with that. Generally, we had the trade report this morning, and it showed a general trend that we've been seeing, whether you look at Hong Kong imports, exports, Japanese import, exports, German import, exports, and U.S. import, exports. They're in contraction now, both on a monthly. They've just turned this, just in the last several months, both on a monthly and a yearly basis. So we're seeing contraction in cross-border trade, or at least there's going to be no growth as of right now. So unless that improves, there's the risk of a global slowdown. And we don't really know how much these can continue to contract the cross-border trade and whether or not it's being compensated for by internal demand. That, of course, is what the hope would be. But this is playing out and it's a central thing that's going on right now.
Yeah, certainly the market's clearly very much, alert to what's going on in terms of all these trade talks. Now, I know you're not a big fan of these, but I always ask you about them anyway. So it's always with your view. The Fed's nowcasts. Now, I saw that the one of them was New York was revised down from something like to 0.8 from 0.9. Atlanta, I think I've scribbled down here, was 1.5, and that's been revised down to 1.1% for the fourth quarter.
Yeah.
Do they kind of look like sensible numbers to you, or are they too weak? And if they are, does that mean the Fed might have to cut again?
It's funny you should say that, because we had motor vehicle sales, and they slowed very significantly in October. And this is really the first indication for consumer spending, even though it's the unit sales involve sales to businesses. It's still an early and important indicator. It's not a slam dunk that how retail sales or vehicle sales are going to do, but it's an opening, a very poor opening for the first indication of consumer spending in the fourth quarter. And so if the consumer does slow and payroll growth is slowing, we also had job openings today in the JOLTS report, and they are definitely down. So will the economy continue to generate enough jobs? Well, I guess we'll have to see. But if that does slow, then a lower GDP, because it's been the consumer spending that has just completely held up the GDP this year, consumer spending. In fact, it contributed 1.9 percentage points to the first estimate of third quarter GDP, which I think came in at 2%. So it's almost entirely the economy itself. And if that goes, and that's why the Fed was able to talk tough, and step away from further rate cuts, at least from now, because of the consumer. And if that does slow, then I think you would see a slowdown going into year end. And we have not really seen any indications that manufacturing's picking up. Something here, something there, but the general trends in these PMIs, for instance, have been coming down, and capital goods orders and the durable goods and factory orders report are just, they've come a sharp contraction in 2 of the last months. Before that, there was no growth, so it's pointing in the wrong direction for the factory sector going into year end.
Okay, let me just slightly change tack a bit. Let us assume then that the Fed is on hold for the time being. I suppose if markets start to believe that all interest rates are bottom, then the next question is, well, when are they going to go up? So let me just quote Mr. Powell from last week. I think we would need to see a really significant move up in inflation that's persistent before we even consider raising rates to address inflation concerns. So does that mean that the idea of Fed tightening is completely off the table over the foreseeable future?
Yes. There is no indication.
Right, thank you very much.
There's no indication of a picking up in inflation. And wages had been showing a little bit of spunk several months back, but that was several months, and since then they've been sagging even more. And if job openings are coming down and job growth is slowing, then you're going to see less, whatever contribution that offered to the inflation rate. That's not, and you don't see it in any of the producer price reports. Import prices are coming down. And it's hard for, and I wanted to ask Brian, when was the last time the Japanese had an inflation scare? When was it? I mean, was it like, what is it now? 0.5, 0.6, 0.7 a year? I mean, when did they ever have, when was the last, in memory, did they have a 2% inflation rate?
I can't remember. No.
Good question.
You stumped me there.
So yeah, there's something going on, and so we're in this, I guess, this new world. But what this has triggered is a ton of money printing by the central banks, quantitative easing, zero interest rates. It's already, we have a high fiscal deficit here in the U.S., accelerating enormously. So you're getting all these fixes, these traditional kind of stimulus fixes, but is it the pushing on the string like you bring up, Jeremy?
Yeah. Worrying times, and I guess thanks for that, Mark. We're going to round off this session then with my part of the world, and kind of central bank, which does appear to have been pushed on a piece of string for a while now. Of course, it's the ECB. Third quarter preliminary flash figures for growth out of Eurozone last week, they showed just a 0.2% quarter-on-quarter increase. So, okay, that was actually a tick above what the market was expecting, but it still equaled the worst performance we've seen from the region since it last contracted back at the start of 2013. Annual growth for Eurozone is now down to just 1.1%, and that's the lowest number we've seen for that particular measure since the end of 2013. October PMIs were pretty horrible too. So, in a nutshell, the Eurozone real economy at the moment really is struggling. Inflation figures we had last week as well. Well, the headline number was down to 0.7, down from 0.9, and that's its lowest we've had since November 2016. The good news, if that's the right term for the ECB, was that the core rate edged up to 1.1%. But bear in mind that the target is still near 2%. So the worry, I think, for the ECB now, and in particular for Christine Lagarde, of course, who will be taking over the president's role at the next meeting on December the 12th, is that we could see falling headline inflation start to dampen down inflation expectations. And were that to happen, of course, you could start to have second round effects and feedback through into the core index. So ECB can't be at all happy at the moment. Sticking with the sort of the central banks, we do have a Bank of England meeting this week. And what can we say about that? Well, just when it seemed as if UK politics couldn't get any more complicated, we now face an early general election on December the 12th. So that's just 37 days away. Now, it's going to be the first nationwide poll we've had over here at that time of the year since 1923. And it's not even because the government wants it. Rather, it's the case that Johnson and co believe that it's the only way they can get their Brexit proposals through Parliament. And of course, for the opposition parties, now with a no-deal Brexit off the table, at least for the time being anyway, it's an opportunity too good to miss. Now, probably the most appropriate thing about this is that the results will be coming out on Friday the 13th. And since no one's really got a clue what they're going to be at the moment, I think that probably sums things up quite nicely.
Jeremy, how can a hard Brexit come back?
A hard Brexit could come back at the end of the day. Well, all we have at the moment, of course, is that we don't have a deal agreed by UK Parliament and the EU. Boris Johnson did get the first round voting of his deal through Parliament, a couple of weeks ago. But his belief most definitely is that at the end of the day, when push comes to shove, he won't be able to get the majority for his new deal to go the whole course through Parliament, which means currently then we have this extension until the end of January, but we don't have a formally agreed withdrawal bill between the European Union and the UK. So let's assume, the Conservatives do win the next election. They try to push forward through a withdrawal bill, which they they might not have enough majority to get to the House of Commons, and we're back to exactly where we were again. And if we can't agree a deal with the EU, perhaps next time we have to ask for another extension, they'll just say no, in which case it's a hard Brexit. We simply fall out without a deal. So as things currently stand, although a no-deal Brexit for the time being really is off the table, it's not impossible to rule it out altogether. And indeed, as we said before, were we to see the likes of the Labour Party and Liberal Dems being able to form some kind of parliamentary majority, then we're probably looking at a second referendum, which of course could cancel Brexit altogether. So still, really is up in the air at the moment, and pretty well everything which could happen, might well happen. Who knows?
So all the extremes are possible.
All the extremes are possible. I suppose really, it's worth mentioning, of course, that I know people can hear from my side. There's various bangs and crashes going on in London at the moment because it's Guy Fawkes Night over here, being November the 5th. And that's, of course, when we celebrate the person who tried to blow up the Houses of Parliament back in 1605. And you can't help but think, after all the trials and tribulations of yet another Brexit extension and now the early general election, with a policy like that, I reckon Guy Fawkes at the moment would do rather well in the opinion polls. Okay, what else have we got to say from my side? Not that much, really. Say Bank of England meeting on Thursday, but against this kind of political uncertainty, there's virtually zero chance that they could do anything with policy, even if they wanted to. If we just strip away the politics for the moment, it's safe to say that the UK economy, a bit like the rest of the Eurozone, is just about chugging along at the moment, but not really much more than that. The inflation numbers have been trending slightly softer, so there's not much pressure for the Bank of England to come out and doing it with interest rates anyway. Although from what they'd like to say on Thursday, they'll probably stick with this kind of central scenario view, whereby they're going to assume still a smooth Brexit and a possibility of higher interest rates, because that should give lift to the UK economy as and when and if it's finally delivered. But we'll just have to wait and see. Okay, what else? I'll just quickly round off, since we're doing the central banks, the Bank of Canada from last week. No change in their 1.25% benchmark rate there. But it's again a bit like as Brian was talking about with Japan, I should say. The Central Bank of Canada making some slight tweaks to its forward guidance, or at least its official statement as well. They've dropped the claim that borrowing costs were appropriate, warning instead that Canada's resilience of economy will be tested as conflicts and uncertainty over growth outlook persists. So again, put a straight line through it, suggests that they're much more prepared to come out and do something towards easing monetary policy now than they were just a few days ago. Okay, anyone else for anything else? Silence is golden. Not on Guy Fawkes Night, really, but
all good.
Okay, thanks everyone. In which case, thanks everyone. We will end it there then. From Brian, Mark and myself, thanks as ever for listening. Do remember to keep up to date with all the key economic indicators and market events in Conaday's global economic calendar, and we look forward to doing it all again next week. Bye for now.